A lot of ways in which you can save money. On this segment of the program, we're going to talk about some of the ways you can actually save money by becoming more energy efficient. And there's a lot of money at stake here for our listeners, isn't there?
Yeah, absolutely. $9 billion in federal and state funding.
Right. And obviously, there's a big debate as to whether those credits were necessary or not, or what they're going to do to the long-term impact of the federal deficit and all of that. We will save that for talk radio shows that focus on politics. Our job here at Dollars and Cents is to interpret what the available legislation is and try and help you make the best possible sense out of these types of decisions that involve your dollars. So there's a lot of credits out there. Right now, people are opening up their power bills from last month and just, in a lot of cases, just being completely surprised by the amount that those bills are coming in at.
Yeah, absolutely. As I said earlier, I received one of my largest bills I've ever had last month, and I noticed that we had an energy price increase with my power company. And then on top of that, the heat. And, just as you get older, I think you drop down the AC a little bit more too. But it was astronomical.
Well, and it's not just this. It's not just perception. It's reality. If you look at household costs over the course of the months of June, July, and August, and compare that to where they were last year, there's about a 12% increase on that. Not just on the cost, not consumption, but cost, just pure cost.
Yeah, no, I looked at that as well, because on the back of my bill, they show you how much energy you used last year.
Sure.
And it was pretty much the same. It was very insignificant difference. So it was purely the cost of the energy.
That's the whole inflation running in there, if you will, which I guess is why a lot of these energy credits were in the Inflation Reduction Act, is to try and address some of these increasing costs by encouraging people to become more energy efficient. The limitations, though, on this is that a lot of the details are still quite fuzzy, but we're going to try and get into some of the overall concepts as we start to see more and more details of some of these energy saving credits roll out in the months and years ahead. So welcome into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning. Joining me on today's show is Christina Lamb, also a certified financial fiduciary and IRS enrolled agent at Nelson Financial Planning, where we got a team of great folks that stand ready this week to help you change your life with a successful and cost-effective financial plan. So these energy tax credits, I mean, they really are pretty powerful because they are tax credits. And so that makes a difference on your tax return, the difference between a tax deduction versus a tax credit. Why don't we talk a little bit about that first, Christina?
Sure. So a tax credit comes off of the amount of taxes that you actually owe versus just dropping down your income, which is a tax deduction.
Right.
So, and as long as you owe money, you will get and see all of that refund.
Tax credits, clearly more powerful than a tax deduction.
Absolutely.
A tax deduction effectively gives you a portion of that back, but a tax credit, it's dollar for dollar. So if you've got an energy tax credit, or you're able to claim an energy tax credit, it's just like getting a coupon of, say, 30% off the total price. And I think you were sharing with me a situation where there was a tax return that you were looking at that where these folks had bought solar, and how much of a tax credit that produced.
Yeah, so in this particular situation, and I think it's pretty average for installing a solar system onto your home from scratch, they spent $50,000 on a solar system. Their tax credit on solar, which would be 30%, came to $15,000. So in their tax situation, it was literally dropped what they would have owed by half because they got a $15,000 credit.
I mean, it really is pretty powerful. Just like a money right back in your pocket that effectively takes the cost of that system from $50,000 down to $35,000. And that's the concept, right? That's the concept behind all of these energy credits. But there's so many different types of energy credits. So what are some of the credits that folks might be able to claim going forward through all of these expanded energy tax credits?
So there are 4 different main types of credits. The first is solar, which we kind of briefly touched on. It is a 30% credit. Now, we've had that credit in the past. This is bumping up the percentage you can get back a little bit. And kind of carrying that credit forward, for future years. The next is the electric vehicle credit. This one you can get up to $7,500 back. You do have to be careful, though. I've had a lot of folks call in thinking that they are going to be eligible for that portion of the credit, and it's very specific. Your electric vehicle, if it's a regular car, it can't be above $55,000, which is really not that much on a car.
Right.
And an SUV is $80,000. And there's specific cars listed. They have to be U.S. made. There's battery requirements. So, like you'll see with many of these, very convoluted.
And the electrical vehicle credit in particular, it's one where details really matter. And you've got to sort of check the box or fit inside the box of the requirements that are laid out to claim an electric vehicle. It's not like you can go out and buy any old electric vehicle and say, I'm going to save $7,500 on my tax return.
Yeah, absolutely. And I think, unfortunately, what I'm hearing from clients is that these car dealerships aren't pointing all of that out. They're just saying, there's a $7,500 credit.
It's
and
electric.
Not pointing out
It's electric.
the specifics.
Yeah, so be very that you know what, that is a fair point, Christina, because it's not the car company ain't going to do your taxes. You're going to do your taxes, and it's probably going to be a few months after it's definitely going to be a few months after the car, because to get a credit, you have to purchase the car in the calendar year, and then you're doing your taxes in February, March, April of the following year. So, the car dealer ain't going to prepare your taxes. So you better make sure that you qualify for some of these electrical vehicle credits. So that's the second category. What are the other 2 categories?
So the third one, I'm considering it appliances. This would be like your hot water heaters, insulation, technically not an appliance, but items that you can add to your house, not a huge necessary cost. So if you're looking for something a little bit more economical, this could be an area you could fit in. You're also getting 30% of a credit on these items. And then the last category is energy saved. So energy saved is where you're going to involve an energy audit, and it's about just your whole house in general being energy efficient. And so here you can get up to an $8,000 credit. Now that is for lower income folks. For higher income folks, it's $4,000.
So, but still, that's a considerable amount of money and a considerable amount of credit that you can get. So, what are some of the tips? So those are sort of the categories of credits that are out there. What are some of the things that folks need to be thinking about now, and in terms of sort of preparing to take or to obtain the greatest amount of tax credits when they're trying to improve the energy efficiency at their home?
I think the biggest helpful thing I saw, considering how convoluted this is there's an app available calling rewiringamerica.org, and so it helps you sort these credits, put in your income, and see what you might be eligible for.
Because these credits, it's not just automatic. I mean, they are dependent upon no less than sort of 3 or 4 different things to be thinking about, right? Beyond the energy saved, you've got to look at your income. You've got to look at your state of residency. I mean, there's all kinds of layers of this. So we're going to try and unpack some of those layers when we return after the break here on Dollars and Cents with Joel Garrison, Christina Lamb of Nelson Financial Planning.